Good afternoon. This is Kathy Neifeld, one of the 4 partners at Agency One. Together with Ed Lesher, Dennis Bartos, and Gonzalo Garcia, I am honored to welcome you to week 3 of the 2020 Agency One annual, and we hope for this year only, virtual advisor conference. Thank you for joining us. For those of you who have joined us over the past 2 weeks, we hope you have found value from the speakers and the content that was shared. During this month, Agency One is hosting over 20 one-hour sessions on a variety of topics, including practice management, tax policy, the economy, estate planning with high net worth clients, sales opportunities, some that are general and others that highlight a specific product, charitable planning opportunities, how you can become a shareholder in an agent-owned reinsurance company, opportunities for wealth managers that are looking for a fee-based alternative to the more traditional life insurance sales process, and much, much more. We have featured nationally recognized speakers, best-selling New York Times best-selling authors and inspirational speakers, speakers featuring economic and legislative updates, product specialists, individuals that focus on sales ideas, and our very own Gonzalo Garcia, just to name a few. All of the sessions that have taken place so far have been recorded and can be accessed by you through the attendee hub. Hopefully, many of you that are joining us today have participated in the conference over the last 2 weeks. So I am going to abbreviate the history of Agency One and how we got to where we are today. For those of you who have heard this before, please indulge me. We do have a lot of new advisors joining us as this session has generated a significant amount of interest. The principals of Agency One have been working together for more than 30 years, always in the life insurance brokerage space. We love what we do, and we love working with the advisors that are part of our Agency One 100 group. One of the tenets or basic value propositions that is central to our Agency One offering is providing educational content, networking opportunities, and idea sharing with our advisors. We hope we are succeeding in providing this to you in this virtual format. For those of you who have attended our conferences in the past, thank you for being with us today. For those of you who do not know us, we hope that this experience will give you some takeaways, that it will help you grow personally and professionally, and that it will expose you to the culture, capabilities, and professionalism of the Agency One organization and family. We have a great schedule for the next 2 weeks and hope you will be able to attend all of the sessions. Once again, the entire meeting is being hosted through an attendee hub where you have access to the entire agenda, live streams, virtual meeting rooms, and a virtual exhibit hall for our insurance company partners, which we hope you will visit tomorrow at 11 o'clock in the morning. Just a couple of housekeeping items. All attendees will be on mute. You may submit questions through the chat function in the attendee hub. This session is being recorded, and a link to the recording will be made available after the session. And please do not forget to complete the session survey after each session. Again, I would like to thank you all for being here today, and I also want to thank Principal Financial Group for sponsoring this session. Now I would like to turn this over to Mark Householder, Regional Vice President, Life Brokerage for the Mid-Atlantic region with Principal, who is going to introduce our speaker. Mark, take it away.
Thank you, Kathy, and thanks to all the partners at Agency One. At Principal, we're super excited to have sponsored this presentation. We have a great partnership with Agency One, and I've always worked together very closely. For those of you on the phone that don't already work with Agency One, they're a great organization to work with, and we really enjoy our relationship. I'm super excited today to get to introduce Dr. Bob. Dr. Bob is Executive Director and Chief Global Economist for the Principal Global Investors. Today, Bob will be sharing his outlook on COVID-19, as well as the federal election's impact on global capital markets, along with asset classes we are currently allocating to. In his role, Bob establishes and directs the global economic policy and strategy. He oversees the conducts of macroeconomic and quantitative research, forecasts economic trends, and anticipates market movements. And he advises the investment staff in making economically sound investment decisions. Bob also directs macroeconomic research for Principal portfolio strategies, an asset allocation boutique of the Principal Global Financial Investors. Bob has numerous speaking engagements in the US and around the world. He's frequently quoted by the financial news media and appears regularly on CNBC and Bloomberg TV. I'm excited to introduce Dr. Bob. Bob?
Thank you very much. Good afternoon, good morning, however the case may be, ladies and gentlemen. It's a real pleasure for me to be with you today. Thank you, Kathy, for the opportunity to chat with you all today. And thank you, Mark, for that very nice introduction. It's kind of just the way Mother laid it out for you. I'm sure. I like to think I'm kind of just a farm boy trying to make it in the big city. As you mentioned, Mark, I got 4 topics I'd like to talk about today. One, I want to visit about the recent virus activity. I want to talk about what that means for the economic outlook, both in the US and maybe around the world. And secondly, I'd like to talk about what the two together mean for possible election outcomes for financial markets and what each of those outcomes might imply for financial markets. And then last, I want to follow that up with kind of an examination of some long-term trends that I frankly don't think are going to change much with the US election, and then look at what those trends imply for financial markets really for the rest of this decade. And I'll also get into some kind of short-term suggestions for market ideas. So let's start with virus activity. Now that's very important, of course, to us because it has such a huge impact on the economy. Now, as everyone knows in all the headlines here in the US, daily new virus cases have been rising again. Yesterday, Monday, the 7-day moving average of daily new virus cases was 57,100. That's up from 34,000, up quite a bit from 34,000 on September 12th. But it's still well below the all-time peak of 66,800 back in late July. Fortunately, fatalities are not rising along with that, nor are hospitalizations rising too much, or even the use of ICU beds for COVID patients. Fatalities yesterday, 7-day moving average was 711 here in the US, which was kind of flat for the last several weeks, but it's well below the recent high of 1142. I think that was on August 1st. Now, the current hotspots here in the US are no longer in the south, but they're kind of in the north and the Midwest. They range from Colorado, North South Dakota, Montana, Wyoming, Minnesota, Iowa, Illinois. Now, there are kind of 2 reasons for this. Either this is just the virus takes a while to get to these states, which it's true. You know, the US is a really big land area country, and it just takes the virus a while to get all around. Or this is the start of the onset of the virus in the cold weather flu season. And if it's the latter, that's certainly not a cause for worry. Globally now, as you probably read, cases are really surging in Europe. They got record cases in France, Spain, Italy, Austria, Denmark, near record cases in Germany. Frankly, Sweden is the only place where they're not record cases. And as you might have read, they had a different approach to the virus. They did not lock things down. So their economy wasn't hurt all that much. And they kind of just said, let's ban gatherings over 50 people. But, you know, you're all kind of smart enough to look out for yourself. Now, there are record cases in Russia, which maybe calls into question the efficacy of the vaccine that they said they've had. Also in India and Indonesia, there seems to be a peak in the cases there. The latest outbreak in China was, well, it was something like 13 people in Qingdao, which is on the sea. And supposedly officials then, once they had that, they tested 11 million people in only 5 days and found no more positive cases. Well, that's maybe a case of Ripley's Believe It or Not. It also shows that, at least in developed countries, it kind of shows that maybe lockdowns don't really prevent infections, they merely postpone them for a while. It also shows, unfortunately, that the virus is very, very resilient, and that we're in the long run just going to have to learn to live with it. I think we're winning. Hopefully, we certainly have better treatments than we did early on, and I think we have a vaccine coming. So, point number 2: what does this mean for the economy? Well, as we've said, the virus is really resilient, but I think so is the U.S. economy. The recession began in March, and it probably ended in April or May, so it was a record short recession. We had a hugely fast rebound then in May and June, but then growth slowed a little bit in July as those cases rose, as we mentioned, in the South. But I think we're seeing continued strong momentum right now, and certainly we're in August, September, and so far in October. I mean, if you look at housing, my goodness, housing activity is just spectacular. Partly from we got consumer confidence is rising. It's still lower than it was, but it's rising, and we got super low mortgage rates. I mean, if you look at home sales, housing starts, building permits, or the number of mortgage applications for home purchase, they're all well above a year ago. And we have home builder confidence has made its second record high in just the last 2 months. Capital spending here in the United States is rebounding. The new orders for capital goods, core capital goods, are above a year ago. Shipments of those same goods are flat with a year ago. So plans for capital spending are certainly very strong. September total retail sales, another new all-time high, above 3.6% above a year ago. Retail sales in September were just surging, or in the third quarter, I mean, probably 50 to 60% at an annual rate. Regional Federal Reserve Bank surveys of manufacturing businesses, Philadelphia and New York, very robust. Small business confidence, the latest NFIB survey, is back up into the range that it was pre-COVID. The number of companies planning to add jobs are the best since December 2018. And there's a record number of companies that say their inventories are too low, which means that inventory accumulation is going to continue to help drive growth into the this fourth quarter. Now, once the reports for third quarter GDP come out in a couple of weeks, we think they'll show a record gain, 25 to 30% annualized growth in the third quarter. And so we're clearly on a path to a sustainable recovery. If you look a little farther ahead, I believe that robust momentum is going to continue into the fourth quarter with probably 6 to 8% growth this quarter. But as we get into 2021, I think that's still a question mark yet, because there just been many of those temporary layoffs and temporary business closures are surely going to turn permanent. So absent a vaccine, we'll probably be back to trend growth next year, maybe in the 2.5% range. But I'm pretty sure we're going to have a vaccine, hopefully in the first quarter. And if that's the case, we'll probably see at least a 2-quarter bounce in the 3 to 4, maybe even 5% growth range. And thus we'd reach a new GDP high next year in 21 rather than wait into 22. Globally, the rebound in China, which has just been really phenomenal, is broadening out. Businesses have been back to normal in China for some time. Households have been more restrained, but I think their spending is coming back. Recent data a couple of nights ago from China show September retail sales, I think 3.3% or something like that above a year ago. And China is the only country in the world that's going to have positive growth throughout 2020. In Europe, there are countries with that huge rise in cases. There are countries restricting activity, so growth is slowing there. But still, Eurozone retail sales have reached a new all-time high, so the economy there is improving, but it's just improving much more slowly than elsewhere. In Japan, it's kind of a similar case as in Europe, although their virus cases peaked maybe 6 weeks or 2 months ago. Business confidence has come back pretty nicely in Japan, but households are very restrained. If you look toward developing countries, the fundamentals are good. A weaker dollar, super low interest rates, and strong demand from China suggest that the developing countries are going to continue to revive. So the world revival or recovery is certainly on track, and I think it continues apace, but it is going to vary by country and by sector, and it's going to depend somewhat on the containment of virus activity in the future. Now, let's move on to my third point. And what we've done so far is kind of set the parameters, both in virus activity and economic growth, that will impact the election and probably not change a whole lot, at least early into 2021. The virus activity may change, but we do think, as I mentioned, there's viruses on the way, and we certainly have better treatments. So we hope we're over the worst. But as you know, the stock market looks ahead several months, so the election may have some impact on the stock and bond market. So let's kind of think about that a bit. Now, there are three centers of power in Washington, D.C. As you know, there's the White House, there's the Senate, and there's the House of Representatives. Now, in the House, the Democrats have, I think, 232 seats, and the Republicans have 197. So the Republicans, if they want to take control of the House, have to gain 21 seats. Now, in this investment climate, I don't think that's very likely. So we're going to assume that the Democrats stay in control of the House. Now, in the Senate, the Democrats likely have to have 4 seats to take control because Jones in Alabama was elected in the special election. What was that? 2 years ago. And it was kind of a fluke election, so he's likely to lose this time. So the Democrats would need 4 seats to take control. Now, if President Trump is reelected, I doubt that there's much chance for the Democrats to take control of the Senate because those votes will likely continue Republican down ballot. So with this in mind, I think there are really 3 main scenarios we have to think about. One is the status quo of President Trump continuing with the Republican Senate, Democrat House. Secondly, would be a Biden presidency, but still with a divided Congress or Republican Senate. And third would be a blue wave or a Democrat sweep where Democrats would control the presidency in both houses of Congress. Now, we have to remember there is the possibility of a contested election. And as you know, markets hate uncertainty. Now, this did happen in 2000. And in fact, the stock market peaked somewhere right around Election Day. And then it fell maybe 10 or 11% until the first part of December on not knowing what was going to happen. Remember the 500 ballots with hanging chads or something like that in Florida. But then the market rallied after the Supreme Court made its decision there in early December. So I just doubt that we're going to have a long contested election like into January or something like that. I think Chief Justice Roberts of the Supreme Court will recognize the gravity of the problem that would come about if our election was contested well into the new year. And I think at some point they're going to make a decision one way or another. So I'm assuming that the result is going to be known by mid-December in time for the Electoral College vote, and that's going to take place on December 14th. And that date comes because the Constitution says it's the Monday after the second Wednesday in December that the Electoral College meets and votes. So what does each of these scenarios suggest about the stock and bond markets? Well, let's start with the status quo. Trump and a Republican Senate will probably have a continued deregulation or at least limited re-regulation. And I'm guessing we're not going to have much higher taxes. In 2021, we'll probably have a phase 4 stimulus, and we'll likely have some kind of decent infrastructure package. Now, this is surely going to be mostly positive for the stock market, good for profits. It's probably good for job growth. But, you know, the stock market's already pretty highly valued. So while there may be some nice upside, I'd have to say the upside is going to be modest. Now, if we do get a little faster nominal growth, that means the sectors in that stock market rally might be a little different. Means we might see outperformance of materials, industrials, financials, maybe even small cap and value stocks. But what about interest rates? Well, if we do have a faster nominal growth, one would expect a little higher long-term rates. So that's not going to be good for bond investors. Now, let's look at the second alternative, maybe of Vice President Biden being elected president, but divided government, Republican Senate. There, we'd get some re-regulation because the president and the cabinet can do some of that on their own. We likely wouldn't get too many tax hikes through the Republican Senate. We may get a bigger phase 4 stimulus and a little more infrastructure spending. Now that spending is certainly going to help the economy, but it likely will help different sectors. It might be not good for energy, healthcare, banks, or industry, or insurance, but it certainly would be maybe a rotation toward green energy kind of things. Now we may see some economic disruption a little bit as the economy tries to realign itself with these new priorities of a Biden administration. And it may be positive because we may have a less divisive foreign policy, meaning lower tariffs and maybe a little less confrontation with China. So still, this seems kind of mostly positive for the stock market. But once again, the stock market's pretty highly valued. So while we might get some upside, it's probably modest. What about interest rates? Well, if we get a little economic disruption as the economy tries to realign itself, that may keep growth just a little slower, which means interest rates might not rise as much, stay a little lower for longer, so it wouldn't be maybe quite so bad for bond investors. Now, let's look at the third scenario, a blue wave or a Democrat sweep. Well, let's think about their economic package. On their website, it's something like totals up $3.9 trillion in net new taxes over the next 10 years, but at the same time, 7.9 trillion in net new federal spending over 10 years. Now, there are lots of taxes. There are higher personal income taxes, higher corporate tax rates. There'll be higher minimum taxes. There'll be taxes on foreign profits, and there'll be much higher taxes on dividends and capital gains. There'll also be maybe some re-regulation of labor markets, probably a $15 minimum wage, and maybe make it easier to unionize and end some of the right-to-work laws. Now, these new tax hikes and some of the re-regulation, surely not going to be business or profit friendly. And the dividend and capital gains taxes will likely detract at least from long-term stock ownership. So at first blush, one would think this would be negative for the stock market, and likely in the long term probably would be. However, the stock market is really going to like that massive new government spending, and the spending will likely happen first, maybe in the first year of a Biden presidency, and the tax hikes might be, they might be postponed for a little bit. So I think the stock market, and if you look at the stock market recently in the last few weeks, it's been going up anyway, other than yesterday. I haven't noticed today, but it was going up along with the betting odds of a Biden presidency. So the stock market is certainly looking at that federal spending. So there could easily be a modest stock market upside on a one-year outlook or something because of that enormous increase in government spending. Well, what about interest rates? Taxes and re-regulation and some economic realignment to green jobs probably means growth is going to slow a little bit. So interest rates might, again, stay lower for longer. Now, this might be the best scenario for the bond market, but maybe not by much because you're still not getting much real return from government bonds. Now, you may have noticed that in this scenario analysis, the 1 year out or maybe a year and a half out, there may not be a whole lot difference from one another in terms of financial market impact from different financial scenarios. We're talking about a kind of a modest stock market upside, and maybe interest rates go up a little bit more, a little bit less. So this is, I think, so why is this? I think this is on account of my fourth topic, because I believe there are some global trends that are going to continue regardless of what happens with the U.S. election. I mean, that's a little it's a little hubris for us maybe to think our election is important, and it is very important for us. But the point I guess I'm trying to make is that there's some global trends that simply do transcend the US election outcome. And I can think of several. Certainly, the coronavirus activity is not going to be impacted by the election. Well, it is true, I guess, that former Vice President Biden did say he would lock the country back down if science demanded it. But I don't think there'd be a broad lockdown. I think it would be more targeted. So, and their treatments are improving and the vaccine's probably coming. So even virus activity is not going to be impacted much by the election. Secondly, the U.S. problems with China, I mean, they're going to continue. Whoever's elected and the next president is going to have to confront the Chinese on probably several issues. I mean, we have Taiwan. Xi Jinping has been talking very belligerently about Taiwan. They've been invading their airspace now for a while. The Chinese have. Hong Kong, they've certainly buttoned down Hong Kong. What about intellectual property theft? I mean, we read every other month about somebody or other being arrested for sending intellectual property ideas back to China. And then there's the militarization of the South China Sea, which a few years ago, President Xi said would not happen. But then there are huge military installations on 4 atolls. And what about the propaganda campaign in the US? Some of you may have seen the Chinese ads in the middle of the Wall Street Journal a time or two, extolling the virtues of the way China does business. So those problems are not going away. Third trend is an even bigger one, and that's globalization. You know, it was fading even before the election, and I think this virus will probably make it fade even faster. Okay, so why was globalization fading? Well, I think for a couple of reasons. One is that China's just plain not as competitive as it used to be. You know, 20 years of 10% wage growth in China has raised Chinese manufacturing costs. In fact, the Boston Consulting Group, I think a year ago, did a study and said that Chinese manufacturing costs are frankly only a fraction below those of the United States. So they're not as competitive. Secondly, you know, the people who lost their jobs when those jobs, manufacturing jobs, went to China or India or whatever, well, they got together, they got mad, and they rebelled at the ballot box. That's why the UK is exiting from the European Union. That was the first notice of that rebellion. President Trump's election may have been part of that. We got the Five-Star Movement in Italy. We got Marine Le Pen in France. So we got the Alternative for Deutschland in Germany. These people are voting for policies to help people, not that help China. And then now, third reason is we've got the virus. And the virus has shown that China is not a particularly trustworthy ally. So the US is not the only one. I mean, Japan is paying some of its companies to move their supply chains back to Japan. India has outlawed 70-some Chinese apps. Australia is talking to China too. So there are several countries reassessing their supply chains and their economic dependence on China. So regardless of who's in the White House, the globalization is going to, I think, continue to gradually fade, and some of those jobs are going to exit China. Now, the last global trend I want to mention is fiscal policy. Now, think about this. Since the 1980s or so, the main response, the main government response to a recession or to try to combat a recession has been through monetary policy. We'd lower interest rates, try to stimulate consumption and investment. You know, it really began with Greenspan. His first problem was Black Monday in October 1987. And he lowered interest rates again in 98 in the Russian debt default in response to the tech bust. And then we started quantitative easing. So that's been the main monetary policy has been the main response or the main way to get us out of a recession. Fiscal policy, you see, had kind of gotten a bad rap back in the 70s when we had that huge inflation and really kind of stagnant growth. So now, however, massive fiscal spending is being combined with aggressive monetary policy. And I think this combination is going to continue under any administration. So I think these global trends are going to continue no matter who's in charge in Washington. And I think this should suggest to all of us that the investment climate of the 2020s is going to be very different from the investment climate of the last decade. Now think just a bit about the investment climate of, say, 2009 to 2019. There was a climate of fear. How many years after the financial crisis did we all worry that there was going to be an enormous relapse into a second financial crisis? We had, that continued for years, and right after the U.S., there was the debt problems in Europe in 2011 and 12. And then all during that time, we had very low inflation that nobody was able to explain. And then the Fed was intensely fearful of deflation, so they kept interest rates at super low levels. And then we had slow growth. Remember, that was the slowest economic recovery in U.S. history. Now, this was a great investment climate for U.S. assets and for the U.S. dollar. Why? Well, because money flowed out of the rest of the world back into the U.S. because we were thought of as a safe haven. You know, the old line that we were the best horse in the glue factory. And that money went into bonds. And of course, the money that went into government bonds had a fabulous return. And this was also a wonderful environment for growth in tech stocks, because those super low interest rates meant that investors they'd look way out into the future at those huge profits, and they'd use these tremendously low interest rates to discount those profits back into a very high present value. So, now this decade is going to be much, much different. I think the fear of crisis is gone. The dollar is weakening, it shows that. And I think inflation is not going to stay negligible. The Federal Reserve has already promised to let the economy, let job growth, let wage growth, let it run hot. And globalization is fading somewhat. So the disinflation that was fostered by globalization is going to fade with it. Then next is this massive government spending is going to suggest that demand will increase more than supply, which is kind of the definition of a little bit of inflation. And then it means that robust job growth should lead to fast wage growth, which certainly is not going to be good for profits. So I happen to think this decade is going to be characterized by just a bit more inflation than we're used to. Now, I don't mean 5 or 6%. I mean like 2.5 or 3%. Just enough inflation that the Fed won't do anything about, and enough that the lower for longer consensus may change their expectation. Now, if this is the case, this is going to be a much different investment climate than the last decade. It means that bond yields, long-term bond yields, are going to need an inflation premium, and they certainly have none today. If you buy a 10-year Treasury bond at 0.75 or yielding something like that, you're going to lose 0.75% or 1% in real purchasing power every single year for the 10 years that you own that. So this suggests that at some point, if this happens, bonds are not going to be a great investment. Secondly, it means that broad stock averages may struggle too. Higher discount rates with a little higher long-term rates, well, that means those future earnings are going to be discounted back to a little lower present value. Furthermore, if we get faster wage growth and a little less globalization, that means that profit growth is going to slow. And in this last upcycle, we had record profit margins. So faster wage growth, a little less globalization, those profit margins are going to come down. So if this happens, how much you make money in the stock market for the rest of the decade? Well, I think you've got to bet on stock market rotation, because the tech stocks are such a huge part of the U.S. economy. I think we're going to see rotation into companies that benefit from faster nominal growth. Those would be more cyclical sectors like materials, industrials, financials, banks, consumer discretionary. Those have been the underperformers of the last decade, which suggests that passive investment in the stock market is not going to be the way to go of the 2020s. It's going to take actively managed portfolios. And I think by 2030, we're going to find that the tech darlings of the last several years may not come to have much. And the reason I say that is there just always seems to be a return to the mean. Just think back in recent history whenever the top 10 market cap companies, world top market cap companies are all in the same sector, that sector just never does well over the next several years or decade. I mean, think back to January 1980. 6 of the top 10 market cap companies of the world were oil companies: Exxon, Standard Oil, Mobil, Atlantic Richfield, Schlumberger, Royal Dutch Shell. January 19, how did energy do the rest of that decade? Well, they got massacred, right? January 1990, eight of the top 10 market cap companies were Japanese, and 6 of those 8 were Japanese banks. Were the 90s good for Japan? Nope. How about January of 2000? Well, 8 of the top 10 market cap companies were tech, Cisco, Intel, Lucent, Microsoft, etc. January 2010, 7 of the top 10 companies were either Chinese or they were companies that dug stuff out of the ground to sell to China. This January, 7 of the top 10 were tech. You know who they are: Apple, Facebook, Alibaba, Tencent, Alphabet, Amazon, Microsoft. Similarly, I think there's a same kind of worry whenever world indices, some area of the world is a large part of the world indices. Right now, US stocks are something like 55 to 60% of MSCI World Index. In 1980, 1/3 of the MSCI World Index were oil companies. So I guess my point is there's always been a return to the mean. Why might there be a return to mean for tech stocks? Well, it's just hard for big companies to grow like small companies do. How can you have $1 trillion market cap company grow at 25% a year? Well, it's just hard. And then bigger companies, well, they get bureaucratic, don't they? They forget that innovation got them there. And a bigger company, it's hard to be innovative. And then when you're an enormous company, then there's the possibility of government regulation, because democracies don't tend to like concentrated power. Well, another way to profit from this change in the environment, if it does happen, is of a bit more inflation, is focus on real assets. I mean, things like commercial real estate, housing, farmland, commodities, emerging market stocks. This may be a decade, something like the 70s, where financial assets struggle while real assets surge. Some of you may recall the years 1968 through 1982, 14 years collectively where the Dow Jones Industrial Average made no net progress. Now, I'm not suggesting that's going to happen. It just shows that you can have some parts of the stock market do well, while broad stock averages don't. So, even if this is going to happen the rest of the decade, even if this is how the decade is going to turn out, it's not going to happen this year. Probably not going to happen next year. Maybe not even 22. So, how do you invest for the interim? Well, first of all, I think right now we should prefer equities to bonds, and I believe caution is certainly warranted, as there could yet be some election year volatility. But after the election or a little bit into next year, I do believe there'll be some stock market upside, regardless of the election outcome. I think the best way to do it is to there'll be some outperformance in the stock market, but I wouldn't overweight tech and growth just for the idea that we may see that return to the mean at some point. I'd keep a balanced stock market portfolio, and it might be a good idea to stick some emerging market stocks in there. I think it's quite possible to see the S&P 500 mid-year or later next year in the 3,700 to 4,000 range. For bond investors, I'd certainly avoid government bonds because you don't get any real return. I frankly would prefer non-traditional fixed income like high yield, preferred stocks, maybe some municipal bonds, equity income portfolio. But I would prefer intermediate term maturity, maybe 2 to 4 years, to protect yourself against rising interest rates down the road. And I'd prefer to keep good quality in whatever of those risk buckets you're interested in. And then I'd for sure keep an eye on the overall investment environment, because I think at some point we're going to see signals that rotation in the stock market, maybe toward real assets with a bit more inflation, we're going to see some of those signals. And I think the signals will be one, a weaker dollar. We've already seen the dollar weaken somewhat, but it's not enough to be a real signal that the turning point has come. You know, we thought we've seen a rotation in the stock market from a growth to more cyclical companies. We've seen it maybe, we thought we might have seen it 3 or 4 times since March, and they all failed. So I think the dollar has to weaken a little more. Also, if we get a steeper yield curve, I think that would be another signal. We're already seeing a little signaling in the 10-30 curve, a little bit in the 210 government bond yield curve. But I think we've got to see more steepening before that's really a signal. And then I think we need to continue to see stronger commodity prices. Dr. Copper has done well recently. My favorite commodity index is the CRB index of raw industrials. They've been making new highs. So I think continued strength in commodities, kind of interesting. Corn and soybeans, grains in the agricultural market have been surging, kind of surprising. So those are some thoughts about both the short and the long term. And I might just summarize, Kathy. I think we're seeing virus activity picking up, but my hope surely is the worst may be over. If we hopefully we'll get a vaccine, we certainly have better treatments, and fortunately, at least fatalities are falling, or at least they're not rising along with the cases. I think the global economy is certainly recovering. It's being driven by growth both in the United States and China, but it does depend on containing the virus. As we look ahead toward financial markets, I think the near term probably is okay for financial markets, but I do think we need to keep an eye out for a significant change in the investment climate sometime in the next year or 2 or 3. Kathy, I might stop there. I don't know if it's possible to have questions, but I'd certainly like to open it up if there are any.
Dr. Bob, that was amazing. I just, I can't thank you enough. We do have a couple questions that did come in, and I'm encouraging everybody that if you have any questions for Dr. Bob, this is your opportunity. Please type them into your chat function and we will address them. The questions that have come in so far. And this is a combination of 2 questions that came in. So for the person that asked the question, you're going to see it modified a little bit. Bob, you started out your presentation and it was extremely positive and optimistic. And you talked about an economy that for the most part is more thriving than anything else. And that is not consistent with what we're hearing on the news. And it feels like, at least it feels like every time you turn on the news, you're hearing about doom and gloom. Do you think that that's more political in nature, or you know, how do you explain the dichotomy to what you're talking about and what's being relayed to the general public?
Well, I don't know, Kathy. I guess my first response would either be to change the channel or to turn the news off. I do think, you know, in some respects, you can cite statistics that kind of fit your overall narrative. Now, if you just focus on the virus activity, of course, you're gonna really think doom and gloom, because there is no country in the world except maybe Singapore where virus activity has gone to 0, and we're seeing lots of virus activity in Europe. I mean, record cases in France and Spain and in the UK. So if you focus on virus activity and the number of cases, it's certainly that is doom and gloom. And if that's the case, then you can focus on those sectors of the economy that did the worst because of COVID. And that's because, you know, you look at sports, you look at leisure and hospitality, you look at cruise lines, you look at airlines. I mean, those are terrible. If you look at say TSA travel counts, we had the daily travel count hit 1 million a few days ago for the first time. And back in 2019, the TSA travel counts were like 2.2 million per day. So we're still, 55–60% below the peak in air travel. And there are no cruise lines going. So it depends on your focus. And if you focus on the unemployment, which is still high, I think the latest number was 7.9%. I mean, that's really high. And if you focus on the broader unemployment index, which I forget what it is, maybe it's in the 12% range. I mean, that's even higher. But I guess I tend to focus on the number of jobs that we've gained. And if you look at, say, the continuing unemployment claims, they have come down from 22.8 million to, I think in the latest week, came down to 9.6 million. So those are the people that are on, that continue to get claims for unemployment compensation. So I focus on that. And then I focus on retail sales, which have made a new high. And if you look at small business confidence, as I mentioned, that's back in the range pre-COVID. If you look at housing activity, this is the best housing activity we've had since the mid-2000s, when housing was just a tremendous boom. So I think it depends on the sectors you're looking at. And as you know, political commentators certainly pick the data points that fit their narrative. They have a kind of a preconceived narrative. So that's part of what I would say. But I try to look at the things that matter. Job growth matters, wage growth matters, and those things seem to be doing quite well at the moment. I hope that explains things for your questioner.
Yeah, I think that it does. We're often faced with that saying that math has no emotion and the numbers don't lie. So if you start, I think what you're saying is start out by looking at the numbers and comparing the numbers, and that really tells a lot of a big part of the story.
Yes, I think it does. And I think you need to look at the overall numbers rather than maybe focusing on one particular piece, which may not be doing very well. And there's some sectors, I mean, even travel and leisure is improving, but they're improving much more slowly than manufacturing, for example.
Now, one of the things that you focused on is the housing sector. And it sounds like there is a great deal of optimism there. But on the other hand, we keep hearing on the news how people are exiting the cities in mass, and that the housing opportunities in the major metropolitan cities are really abysmal. That there is more inventory than there ever has been before. So, are the housing numbers and what you're saying about housing a conglomeration or an average of the housing sector in total, as opposed to looking at specific parts of the housing market?
Yes, that is correct. And I know if you look at downtown New York or some parts of California, I think there are two things going on in like New York, Chicago, New Jersey, California. A part of that's going on there is a leftover from the tax changes of 2 years ago. It was late 2017. Is that when they made the change? And that's when they took away the deduction for property taxes, or they limited the deduction for property taxes. So that really hit high property prices, cities with high property prices like New York and parts of New Jersey, California, as well as parts of Illinois. So that's part of what's going on with some downtown urban centers, is that they're not getting the deduction for property taxes. So house prices have been going down. Secondly, is what you mentioned, which is there is in part a beginning of an exodus from downtown. Not a huge exodus like from Des Moines or from Denver or from Austin, Texas, but some of the big cities. But that's because of the change in work from home. Now, I think the consensus on work from home that the downtown office building is going to be empty, I think that's a little overdone because there are some problems long term if everybody works from home. But when people are working more from home, these small downtown apartments just don't work when you're stuck in your apartment. So So, even millennials now want to get out, have a yard, have a family, have a bigger house. So they have an office to work in. So I think there are a couple of things going on there. But if you look overall, I mean, housing starts today, meaning the number of homes that are getting started to being built, I mean, that's the biggest since the middle 2000s. Mortgage applications for home purchase in total are like 25% above a year ago, just last year. And home builder confidence that I mentioned has had 2 record highs in 2 months. We got the highest last month was the highest in history, and this month is even higher than that. So it's broadly across the United States. Now, as you mentioned, there are particular places where housing is not great.
And consider we're going to stay in that real estate marketplace for the next question, and then we're going to pivot into the stock market. But the last question that I see on the real estate market is, do you see the commercial real estate market ever coming back, given the change in work habits, specifically remote working?
Well, yes, I do, because I think for example, I worked for a principal, and I was one of you had to volunteer to come back to the office, and the first volunteers were let in, I think, on June 15th. Principal closed their downtown offices in Des Moines, like in end of March, something like that. So I went back in, and I like being in an office, and I like the camaraderie, and that's something you just can't get over a virtual network of some sort. It's really hard to train anybody. It's hard to get them infused with the culture of your company over the telephone or over a screen. So, I just think, and you lose some of the kind of instant creativity where you walk by somebody's desk and strike up a conversation and bang, something occurs to you right then. So, and I do think overall, studies have shown you do lose some productivity in the longer run. So, yes, I think some of this is going to come back. Now, there may be some places where it comes back more slowly, but I think there are 2 things that are going to help make that come back. One key thing anyway, and that is just a bit more inflation. Now, I think we're going to see a little more inflation, but it's not going to hit long-term interest rates so much. So I don't think property prices are going to be impacted dramatically from higher interest rates. But what you get with a little more inflation is higher rental rates. Now, where there's a lot of competition, but you do have to be selective. I mean, hotel properties probably not going to be good. I think it'll be a long time before we come back to everybody traveling like they did. Malls, retail malls, they've been hit for a long time, so that may be coming back. Warehousing, I think, is dynamite and will continue to be. And I think office may languish for a bit, but I think it's coming back. Yes.
Okay, let's go into a different subject. We've got someone asking, would you put bets on AI, robotics, or biotech, given the acceleration of tech in general?
Oh, if they're meaning one or the other, I'd probably take biotech, but I think AI is going to do well. However, I think artificial intelligence has maybe been a little overhyped. If you look at some of the traffic lights that are being controlled by artificial intelligence, or some of the other things, we've seen some car accidents even when the car is being run by AI. So I think it's been overhyped. And while it's going to be fabulous in the long run, and we're going to need all of that technology improvement because there are not enough people to do things. So we need all that technology improvement. So I think the faster it comes, the better. I just think AI is going to be a little longer. Whereas biotech, we're going to benefit from all the biotechnology. I mean, look at Regeneron is being used, remdesivir is being used. So Moderna, who is doing this messenger RNA, I think that's a dynamite treatment. It was looked at for cancer. So I think there's lots of opportunity in biotechnology. Hope that answers her question.
I think it did. I think it did. Somebody else is asking that we return to housing. And the question is, what will the impact be when renters lose eviction protection in January? Specifically California, I guess the renters are going to lose that protection that they've got that has been afforded to them due to the current COVID environment?
Well, I don't know how that's going to play out. I'm guessing they may extend that relief for a little while. There's a limit to how long you can do it. I know cases are still high in California, so I do know there are pockets of the country and certainly people where this is a huge problem for them. Which is why I think we do need to get a phase 4 stimulus passed. It doesn't look like there's a lot of politics on both sides that are making a problem for the phase 4 stimulus to get passed. But I would guess whoever is president at some point after the election, it'll get passed, and hopefully that will be addressed.
And then one additional question was, are you aware of any data on what demographics are primarily responsible for the surge in spending and building?
Well, if you look at, there is some data on spending by wage classes, and it's the lower wage 1/4 or 1/3 that are now spending in total above what their spending was a year ago. Kind of the middle levels of income are they're not above last year, but they're very close. It's the high income spending that is the lowest at the moment. There's a wonderful website that gets into this. It's called tracktherecovery.org. And it's very easy to see. And there's a brilliant group of economists that have started this. They're able to get some proprietary data, sales data from a bunch of different companies. And they've used this proprietary data to estimate consumer spending. And they do this on a daily, weekly basis. It's a wonderful website. So I would suggest all your listeners, and particularly this questioner, check that out, because I think that data is there.
That sounds like a terrific resource. Another question that just came in, can you address the burgeoning national debt and the impact of interest payments sucking up tax revenue?
Oh, that's a real toughie. And at some point, I have to say, these huge government deficits are going to be a real problem for the economy. I don't think that's in the next year or 2 or 3, but somewhere down the road, this just can't go on. I mean, think about it just a minute. Okay, so you have big budget deficits. There are 4 ways you can solve the budget deficits. One is you can just say, well, I'm not going to pay it. We just renounce it, renege on the promise. Well, we're not going to do that. The second way, excuse me, is that you can raise taxes a whole lot to pay for the deficit. Well, I don't think we're going to do that either. The third way is that you can grow out of the deficit, which is what happened in the 90s. We grew the economy faster than government spending grew, and we ended up, voila, with a surplus at the end of the 1990s. That's probably a little harder to do now when our debt is this big. Well, the other way you pay off the debt is to let inflation go a little bit, and you pay it off in cheaper dollars. So that may be another reason why I think that a little bit of inflation is coming. Long term, those budget deficits are a real problem, and they will be a problem. I just don't think it's in the next 2, 3, 4 years.
Thank you. And we've got one more question. We're at the top of the hour. Does Ken Griffin see something in the luxury real estate market that the rest of the market is missing?
Well, I don't know the answer to that. He's a pretty savvy investor. I would just say that if that data on the high income group, that they're not spending what they're capable of, that means there's some savings there that is available at some point in the future. So maybe he does.
Okay. Those are all the questions that we have. We are at the top of the hour. Dr. Bob, I cannot thank you enough for this interesting, informative, engaging presentation. You absolutely exceeded all of the expectations of Agency One. I can promise you that. So thank you for your time and your commitment to this session and to Agency One. I'd also like to thank Principal Financial Group for sponsoring this session. We certainly could not have done this without them. A couple of final housekeeping items. Please remember to fill out your surveys. They will be emailed to you sometime later this afternoon. Also, we hope that you're going to join us today at 3 o'clock for a workshop on understanding the I in IUL products and what upcoming changes to AG 49 will mean to you and your clients. Once again, thank you for your participation. We hope to see you at 3 o'clock Eastern Time, and please reach out to Agency One if we can be of any assistance. Have a nice afternoon. Thank you. Bob, that's it. Thank you so